The last time the US government created a new strategic reserve asset, gold, 1971, the price of gold went up over 2,000% in the following decade. In March of 2025, President Trump signed an executive order creating a strategic Bitcoin reserve. The US now holds over 328,000 Bitcoin, and there is currently a bill in the Senate that would mandate purchasing 1 million more. The Senate Banking Committee votes in 4 days. This is not a crypto story. This is a macro story. What's happening in Washington right now is not a crypto story. It's not a price story. It's a structural story, the kind that only becomes obvious after it's already happened. And if you understand what's actually moving beneath the surface, the price of Bitcoin right now isn't the most interesting number. The most interesting number is the date, May 14th, 2026. That's 4 days from now, and if you don't know what's scheduled for that day, you're probably not positioned the way you think you are. Quick note before we go further, nothing in this video is financial advice. Everything here is analysis, pattern recognition, and context. How you act on any of it is entirely your responsibility. Now let's get into what's actually happening. Most people watching this know the basic story of Bitcoin in 2025. It hit an all-time high of $126,000 in October. Then something shifted. Between November of 2025 and February of 2026, over $6 billion flowed out of spot Bitcoin ETFs. The price fell from above $100,000 to nearly $60,000. Fear and greed dropped into the 20s. The narrative turned cautious. Then quietly, almost without fanfare, the flows reversed. April of 2026 became the strongest month for Bitcoin ETF inflows since that October peak, $2.44 billion in net institutional demand. In the first week of May alone, BlackRock's IBIT pulled in $335 million in a single day. Fidelity's FBTC added another $185 million the same session. Daily ETF inflows exceeded $500 million on multiple consecutive days. And Bitcoin climbed back above $80,000. The public sees price action. Institutions see positioning. Here's what almost nobody is connecting right now. Those ETFs are currently absorbing Bitcoin at roughly 9 times the rate that new supply enters the market. Bitcoin's daily mining output, after last year's halving, sits at approximately 450 coins per day. In April, ETFs consumed nearly 19,000 Bitcoin across a 9-day stretch. That's not demand chasing a rally. That's a structural supply imbalance that predates the current move, and one that hasn't been resolved. But that's not the biggest story in the room. To understand what May 14th actually means, you have to go back about 12 months. July 18th, 2025. That's when President Trump signed the Genius Act into law, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. It was the first piece of federal legislation in American history specifically designed to regulate a cryptocurrency. Stablecoin issuers were brought under a bank-like regulatory framework. The OCC was given oversight authority. Full reserve requirements went in, and for the first time, the legal question of what a digital dollar actually is, and who can issue one, had a definitive federal answer. At the time, it felt like a niche win for crypto insiders. The broader market shrugged. Then the data came in. The stablecoin market, which had been growing steadily, accelerated 49% in 2025, reaching $306 billion by year end. Circle and Ripple received provisional national banking charters from the OCC. Institutional capital that had been sitting on the sidelines, waiting not for price, but for legal clarity, began moving in. Senior crypto leadership positions, which had been migrating offshore to the Caymans for years, came back onshore. Regulatory recruiters reported that 90% of senior digital asset leadership searches were now US-based within months of passage. One law, 1 year, $50 billion in stablecoin market growth, the return of institutional legal confidence. Now ask yourself, if one narrow bill covering stablecoins did all of that, what happens when Congress passes the bill covering everything else? The Digital Asset Market Clarity Act, the Clarity Act, is the most consequential piece of financial legislation in a generation. Not because of what it says about Bitcoin specifically, but because of what it resolves at the structural level of American financial regulation. The bill was passed by the House of Representatives in July 2025 with a bipartisan vote of 294 to 134. That's not a partisan crypto bill. That's a legislative consensus that something fundamentally needed to change about how digital assets are classified in this country. Here's the core of what it does. Right now, the two most powerful financial regulators in the country, the SEC and the CFTC, have been locked in a decade-long jurisdictional dispute over digital assets. Which of them has authority? Is Bitcoin a commodity? A security? Is Ethereum? What about everything else? That ambiguity isn't a legal nuance. It's the single biggest friction point keeping trillions of dollars in institutional capital from legally, formally, and permanently entering this market. The Clarity Act ends that dispute. It places most digital assets, including Bitcoin, firmly under CFTC jurisdiction as commodities, not securities, the same regulatory category as oil, gold, and agricultural futures. That classification carries enormous consequences: lighter regulatory burden, clearer compliance pathways, and critically, permission for institutions that couldn't previously touch digital assets to start building exposure. The bill also creates explicit registration frameworks for digital commodity exchanges, brokers, and dealers. It establishes DeFi exclusions. It provides pathways for tokenized assets. And it eliminates the legal gray zone that has caused most major pension funds, endowments, and sovereign wealth managers to stay on the sidelines of this market entirely. This is the part retail investors usually notice too late. The May 14th Senate Banking Committee vote is the next gate. The last scheduled markup was canceled in January at the 11th hour after Coinbase CEO Brian Armstrong pulled his support over the stablecoin yield provision. The question of whether crypto companies could offer yield or rewards on stablecoins, which banks viewed as a competitive threat to their deposit model. Senators Tillis and Alsobrooks reached a bipartisan compromise on that question in early May. The deal was structured to allow reward programs when users actively spend or use stablecoins, while prohibiting passive interest-bearing arrangements that would directly replicate savings account mechanics. Armstrong responded on X with a call to mark it up. Coinbase came back to the table. The Blockchain Association called it a step in the right direction. Polymarket odds on the Clarity Act passing in 2026 jumped from 46% to 64% overnight. That's the market pricing in probability, not certainty. And the distance between those two numbers, the 40% that still doesn't expect it to pass, is where the opportunity lives. Let's talk about what the market is and isn't pricing in right now. Bitcoin at approximately $81,000 sits 36% below its all-time high of $126,000 from October 2025. The Fear and Greed Index is at 40, still in fear territory despite the ETF recovery. Exchange reserves of Bitcoin have fallen to a 7-year low. Whale wallets holding 1,000 or more Bitcoin have added 142 new addresses over the past 6 months, a quiet accumulation signal that doesn't make headlines. Standard Chartered maintains a price target of $150,000 for Bitcoin by year-end 2026. That forecast was issued before the May legislative developments. Archie Invest frames Bitcoin as undergoing a structural transition into a mature institutional asset class, projecting a $16 trillion market cap by 2030, roughly 10 times current levels. These aren't fringe calls. These are institutions with full research departments, regulatory risk officers, and fiduciary responsibilities making long-term structural allocations. And yet, institutional ownership of spot Bitcoin ETFs stands at just 38% of total assets as of the first quarter of 2026. That number has climbed from 24% a year earlier, which is extraordinary growth. But it also means that 62% of current ETF ownership is still retail or smaller allocators. The major institutions, pension funds, sovereign wealth managers, most registered investment advisors have barely started. As of today, only 2 to 3% of registered investment advisors formally recommend Bitcoin ETF allocations to their clients. Think about what that number means. The structure is in place. The ETFs exist. The custody solutions are live. BlackRock, Fidelity, Morgan Stanley, all actively issuing or distributing Bitcoin products. And still, the overwhelming majority of professional capital allocators haven't moved. The question isn't whether institutional money comes in. The question is, what's stopping it? And the answer, consistently, in survey after survey of institutional investors, is regulatory clarity. Not price volatility, not custody risk, not counterparty concerns, regulatory clarity. Which brings us back to May 14th. The timing here is what should make you pause. In markets, catalyst events almost never arrive in isolation. They compound. And the past 18 months have seen a sequence of structural catalysts, unlike anything in Bitcoin's history. January 2024, US spot Bitcoin ETFs launch. For the first time, regulated institutional capital can access Bitcoin price exposure through a familiar product structure, inside existing brokerage and retirement accounts with full compliance infrastructure. The product works. $58.72 billion in cumulative net inflows follow over the next 16 months. March 2025. President Trump signs an executive order establishing the Strategic Bitcoin Reserve. The U.S. government, already the largest known state holder of Bitcoin in the world, holding approximately 328,000 BTC as of February 2026, formally commits to treating Bitcoin as a reserve asset, not to be sold, to be held. The same principle that governs gold reserves at Fort Knox is now applied to Bitcoin. July 2025, the Genius Act becomes law. Stablecoins get a federal framework, the money starts moving, and now, May 2026, the Clarity Act approaches its next Senate gate, the committee markup, where it either advances toward a floor vote or stalls again. Each of these moments seemed to most observers like a narrow technical development, a product launch, an executive order, a niche regulatory bill. And what they actually represent is the progressive, layer-by-layer construction of the legal and institutional infrastructure required for a dramatically larger pool of capital to enter this market. Almost nobody is connecting these signals in sequence right now. There's a second legislative thread running alongside the Clarity Act that's even less understood by the general public. Senator Cynthia Lummis co-introduced the Bitcoin Act, Senate Bill 954, in March of 2025, the same month as the Strategic Bitcoin Reserve Executive Order. The bill would direct the U.S. Treasury to purchase 1 million Bitcoin over a 5-year period, held for a minimum of 20 years as a strategic reserve asset. The funding mechanism involves reducing Federal Reserve bank surplus requirements and redirecting a portion of Fed net earnings annually toward Bitcoin purchases. A budget-neutral construction designed to avoid direct taxpayer cost. 1 million Bitcoin. At today's prices, that's approximately $81 billion in potential direct government purchasing demand. At the prices that would likely follow such an announcement, the number compounds significantly. This bill has not passed. It is not close to passing in its current form, but that's almost not the point. The point is that this conversation, the formal legislative debate about whether the United States government should actively accumulate Bitcoin as part of its national reserve strategy, is happening in the United States Senate, not in a white paper, not on a podcast, in the chamber that writes the laws of the most financially powerful nation on earth. That's a different conversation than we were having 3 years ago. And it's already shaping how certain sovereign wealth funds and foreign central banks are thinking about their own positioning. Are we watching adoption or dependency? And at what point does the distinction no longer matter? Let's bring this back to price mechanics, because the narrative is interesting, but the supply math is what actually moves markets. After Bitcoin's fourth halving in April 2024, the daily new supply entering circulation dropped to approximately 450 Bitcoin per day. That's the structural ceiling on new issuance, hard-coded into the protocol, unchangeable by any government, any central bank, any legislative body. When ETFs were absorbing 19,000 Bitcoin over 9 days in April 2026, they were consuming roughly 4.7 times the entire monthly new supply in under 2 weeks. At the same time, exchange-held Bitcoin sits at a 7-year low. Bitcoin isn't sitting on exchanges waiting to be sold. It's moving into long-term storage, cold wallets, ETF custody, and corporate treasuries. MicroStrategy, now rebranded as Strategy, has been accumulating Bitcoin relentlessly for years. Other corporate treasuries have followed the model. The DTCC confirmed a July 2026 pilot for its tokenized securities platform with 50 or more major financial institutions, including BlackRock and Goldman Sachs, which will accelerate the integration of digital asset settlement infrastructure into traditional finance. When you layer all of this together, declining exchange supply, ETF absorption outpacing mining, corporate treasury accumulation, institutional ownership still in early innings, and a potential regulatory unlock at the Senate level, you get a market structure that doesn't require a retail mania to move. This next piece changes how you should look at the entire market. The previous Bitcoin cycles, 2017, 2021, were largely retail-driven. Social media, Google trends, FOMO, speculative leverage. The peaks were violent. The crashes were more violent. The pattern was recognizable because it was sentiment-driven. The 2025 cycle peaked at 126,000 with a meaningfully different composition of buyers. ETFs, institutional block trades, corporate treasury programs. The correction that followed, down to 60,000, was sharp. But the ETF outflows, while significant at 6.38 billion, were absorbed without a systemic collapse. No exchange failures, no major contagion events. The structure held. What happens after this is historically where things accelerate. Not because of euphoria, but because of structure locking in. Now I want to address something directly because the most common objection at this stage of the conversation is usually, but what if the Clarity Act fails? What if the Senate vote gets postponed again? It's a legitimate question. Senate timelines in Washington are famously unreliable. The January markup was canceled at the last hour. The bill still needs to get out of committee, survive a full Senate floor vote requiring 60 votes to bypass procedural hurdles, then be reconciled with the House version before it can be signed into law. There are genuine risks on the political calendar as election season approaches in November. But here's the thing. The price already discounts the possibility of failure. Bitcoin at 81,000 with a fear and greed index at 40 is not pricing in a Clarity Act success. The market is not bullish on legislative resolution. It's cautious. It's uncertain. That asymmetry is the point. If the bill advances on May 14th and begins moving toward a Senate floor vote, the The structural signal sent to institutional allocators is enormous. Not because one committee vote changes the law, but because it confirms that the political will exists to finally resolve the regulatory ambiguity that has kept the largest capital pools on the sidelines. If the bill stalls again, the price impact will likely be modest because the market hasn't priced in success. But if it advances, you're looking at a catalyst hitting a supply structure that is already under significant pressure, with institutional infrastructure already in place to absorb new demand. This is not financial advice. This is pattern recognition. And the pattern here looks specific. Would you recognize the shift before everyone else? Or would you be the one reading about it in headlines 6 months from now, wondering why you were looking at the wrong numbers? Let's pull back even further for a moment and look at the macro picture, because Bitcoin doesn't exist in a vacuum. The Federal Reserve holds its benchmark rate at 3.5 to 3.75% as of May 2026. Inflation has moderated from its post-pandemic highs, but remains sticky above target. Real yields, the rate you earn after inflation, are positive, which historically has been a headwind for hard asset narratives. Gold has still managed to perform. Bitcoin has recovered from its correction. But here's what's changed underneath those numbers. Binance Research found that Bitcoin's correlation with its global easing breadth index, which tracks 41 central banks, turned strongly negative after the launch of spot Bitcoin ETFs. Translation: Bitcoin, at the institutional level, is no longer trading purely as a risk-on speculative asset reacting to Fed policy. ETF-driven institutional flows are behaving in a more forward-looking way, positioning for expected policy shifts, not reacting to them. The old model, Fed cuts rates, risk assets rally, Bitcoin goes up, was retail. The new model is institutional capital making multi-year allocation decisions that don't get reversed by a single FOMC meeting. The 4-day outflow streak after the April 29th Fed decision was a reminder that macro sensitivity hasn't disappeared entirely. But the magnitude was modest relative to the broader ETF recovery. This is what a maturing market looks like from the inside, not the clean breakout chart that gets shared on social media. The messy, uncertain, 2 steps forward, 1 step back process of a new asset class being absorbed into a system that was built for everything else. And the system is adapting whether the public notices or not. There's a framework I want to give you before we get to the final piece. Think about what actually happened with gold. Not the mythology, the actual mechanics. For decades, gold was traded primarily by central banks, mining companies, and specialized commodity traders. Retail access existed, but it was cumbersome. You had to buy coins or bars, find storage, worry about insurance and counterparty risk. Then, in 2004, the first gold ETF launched in the United States, GLD. Within a few years, it became one of the largest ETFs in the world. Gold prices more than doubled in the years following the product's launch, as an entirely new class of investor, retail, institutional, and everything in between, could suddenly access the asset through familiar infrastructure. The ETF didn't change gold. It changed who could own gold. And that expansion of the ownership pool was the price catalyst. The first U.S. spot Bitcoin ETFs launched in January 2024. We are 16 months into that window. Cumulative net inflows are at $58.72 billion. The peak was $61.19 billion in October. We haven't recovered to the peak yet, and only 2 to 3% of registered investment advisors have formally recommended this product to their clients. Do you think the system adapts or breaks under pressure? In the case of gold, it adapted. In the case of Bitcoin, the adaptation is happening in real time, layer by layer, bill by bill, institution by institution. The question is not whether the structure is being built. It is. The question is where you are positioned when the last remaining friction point, regulatory clarity at the comprehensive federal level, gets resolved. Let me be careful here, because I want to be very clear about what I'm not saying. I'm not saying Bitcoin goes to 150,000 next month. I'm not saying the Clarity Act passes easily, or that the Senate vote on May 14th is a guaranteed win. I'm not saying the macro environment is uniformly supportive, trade tensions remain unresolved, energy markets are volatile, and leveraged positions in the derivatives market represent a real source of fragility in the near term. 63% of Binance Bitcoin futures participants were net short in early May. A negative funding rate environment, while structurally interesting as a potential short squeeze setup, also reflects genuine caution. What I am saying is this: the infrastructure has been built. The legal framework is being established piece by piece. The institutional products exist. The government has formally acknowledged Bitcoin as a reserve-worthy asset. The Senate is 4 days from a committee vote on the most comprehensive digital asset market structure bill in American history. And the supply of available Bitcoin on exchanges sits at its lowest level in 7 years. If the conditions I've described are accurate, and the data suggests they are, then what's coming isn't a rally in the traditional sense. It's a repricing. A structural repricing driven not by retail sentiment or leverage, but by the progressive removal of the legal and regulatory friction that has kept the majority of global institutional capital on the sidelines of this market. That repricing doesn't happen overnight, but when it happens, it tends to look, in retrospect, like it happened fast. The biggest shifts in history never looked obvious in real time. When the SEC finally approved spot Bitcoin ETFs in January 2024 after a decade of rejections, it felt like an anticlimactic bureaucratic decision. The price initially sold off. The narrative was, buy the rumor, sell the news. But the cumulative effect, $58 billion in inflows, institutional ownership rising from nothing to 38% of total ETF assets in 16 months, was anything but anticlimactic. When the Genius Act was signed into law in July 2025, most mainstream financial media spent about 48 hours covering it. Stablecoin market grew 49% in less than a year, $300 billion. Senior crypto talent came back on shore. That's not a niche regulatory story. That's a transformation of infrastructure. We are watching it happen again. In Washington, in the Senate Banking Committee, in the carefully worded language of the Clarity Act and the Bitcoin Act and the DTCC's pilot programs, and Morgan Stanley's newly launched Bitcoin ETF, priced at 14 basis points, attracting hundreds of millions with zero outflows since its April debut. The public sees price action, and the institutions see positioning, and the Senate sees an industry that, for the first time in American history, has the regulatory foundation, the political momentum, and the bipartisan consensus to finally get a comprehensive legal framework across the finish line. That framework changes what's legally possible for pension funds. It changes what fiduciaries can recommend. It changes what foreign sovereign wealth funds will consider as American market exposure. It changes the addressable market for Bitcoin in a way that no single price rally, however dramatic, can replicate. If this is the first time you've seen these threads connected, the Genius Act, the Clarity Act, the Strategic Bitcoin Reserve, the ETF supply dynamics, the institutional ownership gap, I want you to sit with the picture they form together, not as a prediction, as a structural map. Markets reward positioning, not reaction. The people who built exposure to gold in 2003, before the GLD ETF existed, before the infrastructure was in place, weren't lucky. They were early. They saw the direction before the mechanism was complete. Right now, the mechanism is being completed. In committee rooms in Washington, in OCC rulemaking proceedings, in BlackRock's distribution channels and Morgan Stanley's wealth management network and the DTCC's tokenization pilot, and every pension fund that added pending regulatory clarity to its digital asset investment policy checklist. The clarity is arriving, not all at once, not cleanly, but the direction is unambiguous to anyone willing to follow the institutional signals rather than the retail narrative. What you do with that information is your decision. But the informed version of that decision starts with understanding that what's happening right now isn't just a price move. It's a transition. And transitions, by definition, reward those who recognize them early. If this video changed the way you see what's happening in Washington right now, if it made you realize that the Bitcoin conversation isn't really about Bitcoin, it's about the architecture of the financial system being rebuilt around it, hit-like. That tells me this analysis is landing, and I should go deeper into these structural threads. If you've been watching the wealth continuum for a while and this finally made the picture click, if the individual pieces we've discussed before suddenly formed a coherent shape today, drop the word architecture in the comments. I read everyone, and those comments tell me who's actually tracking this with me over time, and tell me what topic should we break down next. The tokenization wave that the DTCC and BlackRock are quietly building, the Bitcoin Act's mechanics and what 1 million BTC in government reserves would actually mean for global price discovery, the macro case for hard assets in a world where 41 central banks are in various stages of easing. I have views on all of it, but what I cover next depends on what you're thinking about. The wealth continuum exists because the most important financial shifts never announce themselves. They accumulate beneath the surface, piece by piece, until one day the picture is undeniable. We're not at undeniable yet. We're at early. And early, historically, is exactly where you want to be. Stay with the analysis, stay positioned, and I'll see you in the next one.